All right, we'll start by taking a look at a few selected uh, so-called discussion questions here, just to kind of reiterate some important points with respect to cost, volume, profit. First of all, cost, volume, profit uh, is often referred to as break-even analysis, and it really is far less than what it is. Cost, volume, profit analysis is really the beginning point of a discussion in business, uh, where you're looking at essentially what happens to net income if we change production, assume that production is equal to sales. More importantly, as production increases, what changes? And cost volume profit analysis looks at two things that essentially change. One being revenues, because revenues are a function of sales. And likewise, two, variable cost will increase as sales increase. More importantly, fixed costs do not change. And so that's an important element in all of this discussion, is that looking at what changes as a result of production changes, what does not. Now again, number two here reiterates a lot of these important points. And again, we're going to assume that production equals sales. That just makes the discussion a little bit easier. We're not going to worry about changes in inventory. That again, sales prices remain constant, variable cost per unit remains constant, fixed cost in terms of amount and for a period of time remain constant. Likewise, too, total costs can be segregated into two pools, namely variable cost and fixed cost, that the relationships here are linear, and likewise, too, that we can begin to understand that, graph it, and that changes will arise simply because of changes in production or changes in sale. Operating income is different than net income. Operating income is a result, basically, using the contribution margin format of revenues minus variable cost equals contribution margin, subtract out fixed cost, and you have operating income. Now, net income is the ultimate measure, but net income is what's left out after you subtract taxes from operating income. So there is a difference between operating income and net income, something that oftentimes people tend to confuse. But operating income is a number that's important because it's the last number that management has some degree of control over. Once you get to that point, then essentially the government will take its cut from that amount, whatever the percentage is, and what's left over is net income. Now, contribution margin is very strictly the difference between revenues and variable cost. And again, in this chapter, we're not going to make a distinction between manufacturing and non-manufacturing. Whether it's variable cost, whether it's fixed cost, all variable costs are included in the calculation of contribution margin. That, again, it doesn't matter. And all fixed costs are lumped together to arrive at operating income. Contribution margin is what's left over after you paid for all your variable costs. Likewise, too, you can view contribution margin as what is available, number one, to pay off fixed cost. And then, once the fixed costs are paid for, so to speak, then contribution margin is basically equal to profit. All right. Break-even point is not a be-all and end-all. But the break-even point is an interesting point at which management can look at assessing risk. With any potential product or any existing product, that the higher the break-even point, the riskier that particular product is. It also means that once we get above that break-even point, that you're earning profit. Below that, you have a loss. So break-even is sort of a beginning of a discussion in terms of risk and a way of comparing different products. Now, income taxes are in and of themselves have absolutely no impact on break-even. Because remember that taxes are subtracted after all costs have been deducted from revenues. the break-even point is that point at which total revenues equal total cost. And that would be that at that point, your operating income would be zero. At that point, there would be no taxes. So regardless of the tax rate, break-even point is a function of revenues, variable cost, and fixed cost. Taxes have absolutely no impact on it. Sensitivity analysis is just a way of companies, management particularly, looking at what if. If you start with a basic model, make certain assumptions, again, the revenue per unit, variable cost per unit, fixed cost are all sort of constant, or will be for this year. And then you can say, well, if we begin to budget for next year, what would happen if, and for example, you could plug in a new sales price, you could plug in a new variable cost, you could plug in a new fixed cost to see what the impact of that would be on contribution margin, operating income, and ultimately on net income. Operating leverage really measures two things. One, the amount of fixed costs, the amount of fixed assets that are used in production. In essence, operating leverage makes a simplifying assumption that management has a choice between using labor or machines. The more you use machines, the more your fixed costs are going to be, the higher operating leverage. Now, why would I do that? Well, one, perhaps you can increase output. Perhaps two, with that you could increase a certain degree of quality with a product. But the problem is you take on high fixed payments. So operating leverage also increases your risk. The higher the leverage, the higher risk. Why would companies do that? Well, the higher the leverage, it also means that any changes in revenues will equal changes in cost. An operating leverage of 3 is much riskier than operating leverage of 1. Now, it also means that if my revenues increase by $100, that my income will increase by 3 times that amount. Okay, I'm sorry, I misspoke myself. It would mean, for example, that if sales increase by 100%, not in terms of dollars, but in percentage, then my operating income would increase by 300%. So that's sort of the reward part of operating leverage. The question is, can a company sustain a really high level of sales to operate above that? The higher the operating leverage, the higher the break-even point is going to be as well. All right. Certainly, a company that has multiple products can use CVP analysis. The additional constant that we assume, in addition to the revenue per unit is going to remain constant, the variable cost and fixed cost, is that the mix ratio remains constant. And we'll see here in a couple of minutes, we'll go through an example using this to analyze a company with multiple products. Okay, problem number 16 is I won't say it's simple, but it's a good example of looking at, certainly from your notes and others, you can look at, well, what do we mean by this definition of total revenues minus total cost, okay, equals operating income? Well, okay, if that's true, if total costs are equal to variable cost plus fixed cost, okay, then it means that if my total costs are $1,200 and I know one part of that, $800, namely my variable cost, then I can plug in the difference there of $400 in my fixed cost. Likewise, going back to the basic formula, total revenues minus total cost equal income. So therefore, if I know these two elements here, it means that my total revenues must be equal to $2,200. Now you'll notice in the solution, it didn't specifically ask you to do this, but it certainly helps to have this amount here, that you need to calculate the contribution margin, because the solution is asking you for this contribution margin percentage. Okay, I'll do one more example here. Let's look at B. That is, okay, starting from the information that they gave me here, what do I know? Well, one of the end products that I know here is that operating income is $700. Well, fine. What's the definition of operating income? Well, it's total revenues minus total cost. Therefore, what I can do is plug in my total cost. 24 minus some number x equals 700. So therefore, my total cost in this situation must equal $1,700. Now, once I know that, if my total cost is $1,700, then if I know my fixed cost is $400, variable cost must be $1,300. And then at that point, I can calculate my contribution margin and contribution margin percentage. All right, number 17 is really sort of a straightforward problem. And it's asking you to do basically two things. One, calculate the contribution margin and operating income under existing circumstances. And then in number two, it assumes, well, what happens to our operating income if we make certain changes in a form, a type of sensitivity analysis. And so what it's asking you to do is basically prepare a contribution margin format income statement under these two assumptions. Well, one, they're going to hold constant regardless, is that they're going to sell 410,000 units. And they're selling them for $68 per unit. The variable costs are $60 and the fixed costs are $16.40. Now, number one just says, okay, given that, prepare the contribution margin income statement. And number two, it says, well, okay, we can take this basic model and then let's substitute some changes. Essentially, what they want to do is to increase the leverage because they want to increase the annual fixed cost, which basically means what they're going to do is to increase the use of machines, but decrease the use of human labor. So therefore, variable costs will go down to 54. The other assumption here is that the sales price of 68 will remain constant. And they're just say, okay, fine. What would the contribution margin income statement look like? What would operating income be? And in comparing the two of them, which is better? Maintain the status quo, that is number one, or do we make this change? Okay, so number one says, okay, look, okay, let's go with this basic assumption, 68, variable cost is 60, 410,000. So here's my contribution margin. I subtract out the fixed cost. I have this amount of operating income. Now, assumption number two says, look, okay, total sales don't change. There's still going to be 410,000 units, same as $68. But what's going to change is this is going to go down from 60 to 54. So my total variable costs are going to go down. Therefore, my contribution margin will go up. Okay. However, fixed costs are increasing by a significant amount too, namely in the amount of 5,330,000. So when I subtract that from my contribution margin, my operating income in this case is only 410,000. So my decision is, very simply, which alternative would I choose? I have to make a choice here. I can maintain the status quo, which is option one, or I can make a change at option number two. Well, as most of you would say, well, yeah, duh, I would be better off maintaining the status quo because I'd rather have operating income of this amount than that amount. And yeah, the benefit of maintaining the status quo is 1,230,000. So why would we do it? Why would we take on a proposition that will cause us to lose money? It doesn't make any sense. All right, number 21. This is a relatively straightforward problem. And the difference in this one is asking you to work with break even, but it's also targeting two things. One, most companies are not in business simply to tie or to break even. And they want to earn a certain target net income for a lot of the reasons we talked about. And likewise, too, they also have to deal with taxes. Now, remember that when you deal with taxes, go back to the basic form of the income statement, and you're basically going to be working your way up. Now, in this case, they're selling one product, and they're selling a car for $27,000. One of the variable costs is they have to go out and buy it from the manufacturer for $23,000. So that $23,000 would be considered a variable cost. $48,200 in rent is going to be a fixed cost. Now, the utilities of $68,000 would likewise be $68,000 for the salaries would be a fixed cost. The $600 here would be a variable cost because that will vary according to the amount of sales that are done each year, okay? And the final thing here, the $13,000 is simply the fixed cost. So like we've done before, variable costs are additive. I can add up all of my variable costs and figure out what that amount is per unit, and obviously do the same thing with fixed cost. In this case, the first thing they ask you to do is to calculate the break-even point, given those assumptions. And remember, at the break-even point, I could ignore taxes because my operating income would be zero. Now, in assumption number 2, what they wanted you to calculate is, well, okay, fine, we can calculate whatever the break-even point is. If we want to earn a target net income of $51,000, how many units must we sell? And oftentimes that's the big issue. And we have to achieve that. Now, remember, we're starting from net income, okay? And we're going to work our way back up the income statement to operating income because that's the last thing over which we have control. I can, excuse my bad writing here, but writing with a mouse is not that easy. Okay, I need to subtract out my tax. So if this is my net income, I'm going to have to subtract out the tax. So this is what I'm trying to achieve because remember, going back to the basic formula, fixed cost plus operating income gives me that unit of sales that I must achieve either at the break-even point or at a target net income. Now in the first scenario, it's relatively straightforward. The first step is simply to add up all my fixed costs, find out what that total is. Likewise, add up all of my so-called variable costs per unit and find out that I need to sell 38 cars. My variable costs per unit are basically $23,600. So when I subtract that from the sales price, it gives me this contribution margin per unit. And the basic formula, at least for break even, and actually it's always that, fixed cost plus operating income divided by contribution margin. Well, at the break even point, we're assuming that operating income is zero. So we can sort of ignore it. So again, 38 cars. Okay. Now, again, what the question is asking you is, how many cars do they need to sell in order not only to break even, but to earn this target net income of $51,000? Again, assuming we're working our way up the income statement. Well, the basic rule is take that target net income and divide it by 1 minus the tax rate. This becomes then our target operating income, because at that point, that's the last number really that management can control, because beyond that, then the government will take us 40%. So once I achieve this as my target operating income of $85,000, it's not going to be given. You're going to have to figure that out. I plug that into this formula here, where I take the fixed cost plus that, the target operating income of $85,000, and divide it by the contribution margin. So that would give me 63 cars. Again, the difference here is 63 versus 38. Okay, it means, okay, the incremental difference is the amount of number of cars I would have to sell in order to earn that target net income. All right, I don't always trust my mental math here, so I had to calculate this out. So that means they would have to sell an additional 25 cars in order for them to achieve that. So the question is always, okay, can we somehow do that? Or more importantly, what do we need to do in order to sell those additional 25 cars? Because the 51,000 is not something we pull out of a hat, but that's imposed on us by our investors that are demanding a certain return on investment. All right, let's talk a little bit about margin of safety, which is basically just the difference in terms of where your sales are or what you anticipate them to be versus what the break-even point is. Now, in this case, they make the problem a little bit more difficult than they need to. But part of it is kind of understanding the issue of identity. And at this point, remember that the break-even point is always going to be total revenues minus total cost equals 0. So we know the total revenues are $1,500. Likewise, we know the fixed cost is $7,200. Therefore, my variable cost must be $7,800. That's just simply a matter of identity. It also means that if my variable costs are this, And remember that at the break-even point, the contribution margin equals the fixed cost. So therefore, my contribution margin is going to be $720,000. All right. In my mind, there's actually a very simple way to do this that avoids a lot of the more complicated algebra. They give you the fact that variable costs are $13 per unit. Okay, well, that's fine. How about if we just take that and we're going to divide $13 into 780,000. And what you end up with is what they have here, 60,000 units, okay? That is assuming that my variable costs are total $780,000. And if they give me up here, that is $13 per unit, that means that I'm selling, by definition, 60,000. At that point, 60,000 times 13 will give me $780,000. Now, once I know that, then it becomes a very straightforward proposition. Divide 60,000 into 1.5 million, and you end up with $25. So the algebra is probably, they make it a little bit more complicated than what it needs to be. All right. Margin of safety, well, if they're selling at 90,000 and the break-even point is 60,000, then they're 30,000 units above the break-even point. So you can talk about margin of safety as being 30,000 units. Sales would have to decrease by 30,000 units in order for them to begin to lose money. Or the other way that you can express it, which is a little bit more meaningful perhaps, is to express the break-even, the margin of safety in terms of percentage. And that is, if I take the 30,000 units and divide it by the existing sales, it means these existing sales of 90,000 would have to decrease by 1/3 before we would begin to lose money. All right, finally, multiple products. Well, the nice thing here is that they kind of streamline the solution for you here somewhat. And what they do is they say, look, okay, product A has that contribution margin per unit, B is 4, and likewise C is 3, okay? Again, A has a contribution margin of $5 per unit, B has a contribution margin of 4, and C has a contribution margin of 3. Now, the tricky part of doing multiple products is not in the contribution margin part of it, but in the ratio analysis. And so what they're saying is that right now, or what they're budgeting for existing, okay, is 168,000 total units, okay? Now, of that total units, 24,000 are A, 96,000 are B, and 48,000 are going to be C. Now, the trick to doing multiple products, and what I did was I wrote up here the so-called amounts that equal 168,000. You want to reduce this down to the kind of the lowest common denominator or down to a usable ratio. Well, in this case, it's nice and neat. I can divide all these numbers by 24, and I come up with a ratio of 1, 2, and 4. Now remember, the other fundamental assumption under multiple products is that, yes, you are selling 168,000, but the break-even point is not expressed initially in terms of, oh, how many units of A, B, and C. Rather, how many bundles or how many baskets do I sell? And so at the break-even point, the first thing I have to calculate is, what is the total number of baskets or bundles that I'm selling? Because then I can say that within each bundle, I will sell 1 product of A, 4 products of B, and 2 products of C. I'll repeat that again. That is, let's say I'm selling 10,000 bundles. Well, fine. No matter what that number is, each bundle will contain 1A, 4B, and 2C. So the next step is, okay, what is the contribution margin for that bundle? Well, this is what we've done. We've taken the contribution margin times that reduced ratio. Now, you could leave it at 24,000 and 96 and 48,000. All you're doing is you would end up with the same number, but you're going to have a lot of zeros to work with. So this just makes it a lot more streamlined and easy to work with. And so my contribution margin per bundle is $27,000. Or excuse me, I'm sorry, $27. So now, once I've done that, this is my contribution margin, but not per unit, but per bundle. Fine, I take that, divide it into the fixed cost, which is the basic break-even formula, and what I know is I will sell 15,000 bundles. So now I take that and multiply the 15,000 times its respective ratios. I end up with 15,000 of A, 60,000 of B, and 30,000 of C. And if I want to know what the total contribution margin is, now I can take the 15,000 times 5, the 60,000 times 4, and the 30,000 times 3, and figure out what the total contribution margin would be at that point. So in this case, at the break-even point, that would require that they would sell 105,000 units in terms of total. Now, since they're selling 168,000 total, we can obviously conclude that they're operating well above the break-even point. And again, that's demonstrated here in part number 2, where they ask you to go ahead and take that and use this contribution margin format to determine what is the operating income of the company. Well, again, it's not surprising that they're operating at 243,000, given that 105 is being the break-even point and they're selling 168,000, that they're substantially above that. Okay, part number 3 is simply saying, what would happen if we change the mix, particularly if we were to swap the numbers between B and C? Remember, initially we thought that B would be selling 96,000 and C would be selling 48. What would happen if we flip those numbers? What would happen to the break-even point? Well, sometimes it's very difficult to predict, so we need to go through here and figure out what would happen with that. Well, 2 things that we know, okay? One, I can calculate the operating income under that assumption. Again, they're still selling 168,000 units. That doesn't change, but I can't make the assumption because we've redistributed. Remember, this is the important point that really defines profit in addition to this. So profit is going to be defined in terms of both how many I'm selling and the contribution margin per unit. Generally, making a migration towards a low contribution margin product at the expense of a higher contribution margin product is never a good thing for a company. But I need to kind of look at the numbers and determine, well, how much of a difference is it? But given this assumption, okay, that we're going to sell these amounts here, then the contribution margin that they would generate would be 600,000. And given the fixed cost remain 405, well, fine, it looks like they're about $48,000 worse off, okay? That they've had this migration to a low contribution margin. That would not be a good situation for the company to do that. So they would be far worse off. Now, likewise, if I wanted to, and this is the second part of the problem here, I could calculate the break-even point and kind of substantiate, come up with the same answer. This is not a good situation. Taking the contribution margin, okay, that each product will produce in that bundle, okay. So the contribution margin for that bundle is going to be 25 versus what it was above here. Oops, let's find this, okay. Where is it? 27. So they're giving up $2 of contribution margin. And again, to a certain extent, I could kind of stop at that point and say, you know, this is not going to be good. If we decrease the contribution margin, we're in fact really going to increase the break-even point, all things being equal. But again, I need to kind of run the numbers so I can take the $25, divide it into fixed cost, and realize, oops, okay, that in fact my break-even point has gone up from 15,000 to 16,200. So 2 numbers very clearly are in, tell me don't do this. I've increased my break-even point, which means I'm increasing my risk, and likewise my operating income has decreased.